And a very good morning to you, and welcome to the TriggerCharts pre-market rundown for Friday, January 21st, 2022. Hopefully you're surviving what looks like a horrendous drop in market sentiment and overall markets when it comes to pretty much everywhere far and wide. We're seeing a lot of carnage. And much of that is due to sentiment. We always talk about markets being all about confidence. And the fact of the matter, as we're seeing it right now, is there's a lack of confidence, as we can see, because yesterday there was this rollover towards the end of the day, and we saw the same thing the day before. So essentially what we can take from that is that the buying, the rallies are being sold right now. And we've been talking about this sentiment and this wacky movement in markets and levels and where we are, but I really want to get into another discussion today with you regarding trade bias. The idea of looking to figure out where it is that we want to be, either long, short, or out, and that is something that the TriggerCharts Commander Series does provide for you. Let's also note that investing involves substantial risk, and past performance is not a guarantee of future results. Information that we talk about today should always be construed as not construed as an offer to buy or sell any securities of a particular security. And because please consider this for educational purposes only. You could lose money when you invest. We know that. And right now is a good testament to a lot of people in the markets, particularly those that are only on the long side losing substantial amount of money. So right now where we are is in a time that we need to reconsider what we're doing, look at the size of our trades, the consideration of how much we're putting on, looking at whether we're trading, we're day trading, we're swing trading, we're long-term investing. There's a big difference in all of those. In these kinds of conditions that we're seeing right now, if you're a trader, a swing trader, a day trader, you may want to take certain positioning throughout the day and maybe go home flat, no positions at all. If, on the other hand, you're an investor, you may have said, well, I'm going to take some profits here, or I'm going to buy some more on the dip. I'm going to look to short for the long term. Whatever your particular positioning was on that particular security, those times are much different because we can look at these as opportunistic times to look for levels that are really good for bounces and finality when it comes to moving into a position. Quick check on markets. The Dow Jones Industrial Average Futures are down 94, 21 down on the S&P 500. NASDAQ down 122. To the right here, we're seeing a chart that shows us the Qs, the triple Qs, down right now at about 358. Right above what I've drawn in is the next level of support. But boy, this has been a disastrous, a horrible overall move to the downside. I mean, this move that we've seen right here has been really rough. The idea that we came off so quickly really is a mirror of what we saw over here, right? The same discussion of how we moved up so quickly. We essentially have evaporated all of that to this point. Question is that a support point with good valuations, or do we now look to evaporate this incredible move that we saw from April through, we'll call it August of 2021? Big question. A lot of that's going to be due to what we see in earnings season that's coming up next. We did see the banks come out last week. Things were okay. I think the banks are actually showing up pretty nicely overall with not only their earnings currently, but also with their outlook. So things are kind of good, I would say, in the banking sector. But when you combine that to what else is going on here and the fact that when people sell, they sell in their passive investments. And what that does is take down the entirety of the market structure. And that's kind of what we're seeing right now. Let's talk about the theme for this week. And by the way, thank you so much for making us the number one highest rated, number one overall in the trading app store. From the report I got, I met with some people last week over at TradeStation. They were telling us that. I think the theme this week we have to look at, and it's a tag from last week, is kitchen sink. Is this a kitchen sink move that we're seeing right now? Is saying, let's just get out. Let's just forget about this market for a while. Let's get off leverage. Let's bring down positioning. And this bounce is not going to happen like we've seen it last time. Now, in all fairness, we could have said that how many times before? Oh my gosh, it's the end of the world. Markets are coming down, 7, 8, 9, 10% correction in the NASDAQ or the Dow or the S&P or any particular area. I will share with you one thing that I find very interesting, and that is that when you look at the components underneath a particular index, whether it's the NASDAQ or the Russells or the S&Ps, large cap, small cap, mid cap, there is a lot more damage that has been done underlying the actual index than we're seeing in the index itself. Now, how does that happen? There's a lot of different reasons why that happens. The risk is spread out across a number of securities, but when you see that 30% of stocks in like the NASDAQ are down 30-something percent, 40% from their highs, you would say, well, that's pretty rough. However, at the same time, we have to, I think, understand that they were well off above where they should have been from a fundamental and valuation standpoint, unless you just consider zero interest rates forever. So the Fed essentially started this whole run on the markets right now, and what we're seeing is this takedown. And what's really fascinating about that is even yesterday and the day before, one of the reasons we saw the bounce in the morning and the recovery attempt, the rally in the early parts of the day that were pretty strong across most sectors, was due to the fact that bond yields actually came down. They're coming down again. People are buying bonds. We hit 1.8 plus, 1.88, I think it was last week or something of that nature. We're down in the 1.7s right now. Meanwhile, look what's happening. As we're talking, the Dow is starting to shed further, so is the NASDAQ, and we're starting to see that this is a significant amount of losses. 1% a day multiplied by how many days already in the new year, and we're seeing one of the worst starts of the year for many, many years. We're seeing one of the worst months in the NASDAQ since, I think, March of 2020. So pretty bad situation here. One of the things I do like, and I try to weave this in each and every week of my speculation of what will happen. One of the big things that's weighing on the markets this morning is Netflix. The earnings came out last night. Netflix did come out with better than expected earnings. However, their subscription, their additions going into next quarter were very light. 2.5 million, expecting 6, 7 million. Now, sometimes they do sandbag that. You combine that with what's going on with Peloton, some of these other names out there, and I do think there is a baby with the bathwater condition that is going on right now. However, you're not just seeing it in one stock or two stock, you're starting to see it across the board. Look at what's going on with Bitcoin and the entire crypto space right now. What we're seeing in that is the same situation. Big sell-offs. I mean, cryptocurrencies sell-off is anywhere from 7 to 12% overnight. And meanwhile, we're starting to see all this risk off going on. Now, the idea that cryptocurrencies right here was supposed to be some kind of hedge and some kind of inflation hedge, some kind of uncorrelated assets, I think people are starting to realize that's not necessarily a fact. I will share with you, I think it's a better sign that we're seeing the move down into the bell here than would be the case if, in fact, we saw the opposite happen. Because if rallies are being sold, there is some thought that maybe we are starting to get a flush out of some of these numbers. In particular, I think it's also important to remember that next week we have earnings season that's going to be happening. And earnings season is very important because it is going to be the make or break it, really, and that's been time and time again. Estimates have been lowered down. Technology stocks have been brought down from their highs. The idea that they are going to have a slowing earnings outlook due to the fact that interest rates are higher and moving higher, and the valuation metrics that we utilize in valuing from a valuation standpoint, from a fundamental standpoint, have been significantly damaged due to the fact that we have 4, 3, 5 rate hikes that are being included over the next year. That's a big issue right now when it comes to technology stocks. That is a big issue when it comes to the stocks that are not profitable and have a path to profitability, but yet at the same time may have a more difficult time raising capital at higher rates. So a lot of that's all converging at the same time. So I do think we're at a baby in the bathwater moment right here. It is a terrible market right now. There's no question about that. But it's tough at all ends. I do think that we are seeing a very significant point that I really want to bring out right now for those of you that are buy and hold players. Those of you that have been looking for buying the dip, different than just the investor that is looking for a daily move and a trade. So we have a mixed bag of people here, and probably your particular portfolio is a mixed bag as well, right? Your portfolio is probably core or somewhat a buy and hold to a degree with either equities, mutual funds, ETFs, or something of that nature that you hold for the long haul. Could be in your 401k plan, could be in an IRA. And then you also have a mixture within the portfolio of other more tradable assets, whether, again, it's swing trading a few days, whether you say, hey, we're going to buy this dip. If it goes down below this level, that's my stop. And I'm going to look for this to climb 8%, take my profits, et cetera, or maybe do a trailing stop, or whatever exactly that you're doing. Now, what I would suggest to you that right now, and let's talk about this right now, is the idea of the buy and holders, right? The investors of you out there. I would start talking about, and I'm mentioning this a lot, bringing up a watch list of securities that you like for the long haul, whether it's in Amazon or Microsoft, or whether it's in the healthcare, Pfizer, or some other name out there, whether it's maybe even a Netflix today on this massive move lower, you think that that's going to be good for some reason that you did the research on, you did the work on, and you start making that list and figure out utilizing levels, which we'll talk about in a second, which I'll skip over that, I guess. Let's go over here. Let's talk about like a Netflix, for example. So Netflix right here, this is a daily chart. Well, I'm going to expand that. When I look at this, I want to look at this from a different eye than we usually do. I'm going to spread this out to a weekly level. Now, Netflix is going to trade down to about 401 right now. That's where it's trading right now. So Netflix is right about here. No, it's not. It's a little bit lower, right? Let's call it right about there. Give or take $1 or $2 right now. Where is Netflix? Well, Netflix looks pretty vulnerable to me, all the way down, potentially maybe to about 360, another 8-10% from where it's going to hold at the open at 400, maybe a little bit lower, probably crash down below. There's a weekly chart. This is a long-term chart going back to 2020, but you see how we could utilize the same long-term chart. If we want to get crazy, and you want to think long-term, that's the same number we just put in there. This carries over to all the charts. Same level pretty much, 375, 365, which is a relatively good level for Netflix that has spent its time in that range from 2018 in June all the way through, we'll call it the breakout right here, which was April of 2020. So almost 2 years is spent in that range on a monthly basis. So again, right now we're going to be trading. Let's push this back into where we were at the 400 and, oops, let's move it down, 400 and, right there. Not a lot on a monthly that we're looking at is very exciting. Maybe trading down to 368. I would pencil that in on a daily and a weekly basis. That's something I would look at. You look at this, let's go back to the daily. Nowhere to be found because it's way down here, and this will open up. Let's see if we can, way down there. Gotta get that in there. Point is, and what I'm trying to project right now is the idea that this is for the long haul. For those of you that are in it for the long haul, right? For those of you that are looking to invest rather than necessarily just trade. And this could be used for both scenarios, particularly when we're in a situation as we are in right now. My expectation is that there is a very high potential if bond yields come down. I don't know if the NASDAQ necessarily will come back. I would think maybe the S&P and the small caps could have a shot. Small caps are IWM looking pretty awful, by the way, down about 70 basis points in the pre-market right now, dripping below support here, but have some support at the 199, just below where we are. Let's see, 199.50. Right where we are right now is a reasonable level for a stop for a moment, take a breath moment. That doesn't mean it's going to stop there forever, but they've been lagging. And one of the things that we always talk about is, again, whether it's a daily, it's a weekly, it's a 5-minute chart, let's use our box tool. It's just so easy. And you can see that when I just draw a simple box around, there was a really big and long and very substantial consolidation throughout the year 2021, all the way from 2021 right here, all the way through 2022. And it's resolving to the downside. Now, with rates that are moving up, that should be decent for banks, right? We know that. Everybody told us that. You've heard it 1,000 times on television from the talking heads. I would agree with that. When you have the opportunity for rates to move higher, net interest margins for banks are better off. When you look at how banks make money, it makes sense. Just simply they loan money out, they take money in, they give credit on bank balances on account, etc. Well, when this happens, it's actually a good thing for banks. This index is full of banks and small cap energy. So what's happening right now is this, I think, could be a baby with the bathwater to a degree right now. However, we'd have to see that it's also very vulnerable because it's thinner trading that goes on with these stocks and could be more of a problem. But let's just get back to this. I think it's really important about learning about when to trade, the time, your time frames, your trade bias, all these things that we talk about right there. This idea of reversals, looking for the opportunity to get into a position on a bounce. Take the fear, check it off at the door, take your concerns, and use your logic. Now, even when that fails a little bit and things aren't going away, and that comes back into play, the idea that, oh my gosh, my logic's not working, now I'm doubly fearful, I don't know what to do. A lot of you are probably in that position right now. I don't know what to do. I'm down 15% this year so far. It happened so quickly. I get it because we manage money, and I get it. It's a little bit difficult, this market right now. The fact is we have that component of short-term and long-term right now. Short-term, I think there's great swing opportunities to the bull side. I'll be honest with you. I think there's a lot of opportunities and things are tremendously oversold. Key levels that a lot of people are looking at is like 200 days and all that. We don't really look at that as much. We glance at it. But really what I want to look at is where we are. When we look at the SPY, where are we? Now, this is a daily on the SPY long term. Where is this right now? SPY looks like it's going to open up at, what is that, 433? 443, excuse me, 443. So right about here, which has some support, but our aileron is kind of choked off to the downside here. Not looking so good. Where do I want to really start buying that? 445 looked like it bounced right off of that yesterday, held on that. Where are we going right now? 443, a lot of congestion as I look further back. Again, taking the side of let's go a little bit longer right now. And you'll look that we have some decent support on a weekly basis. This goes all the way back to 1126 at 449. Significantly lower that right now, but we're at 442.5, which is right where, a dollar from where we are now. So this could bounce. This is a major point when we look at a high volume node or the point of control, which is right here, right? This line right here, this blue line right here. That's always our highest level of conviction inside of a trading range. Usually we see as things bounce, like it bounced right there. Didn't get below here, bounced up into it and kind of came in. When it gets through that, that's a really good sign that things are going to get a little bit better. Once again, bounce, 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 bounce. Came up into and in between and worked in between this zone. We did roll over right now. And, if you look at this, it's not that big of a move, but it has happened very quickly. Talking about 473 down to where this is right here at 446, 443, where we are right now. 30.7%, give or take a couple of dollars. Not good. We're seeing an oversold reading on a weekly basis for the aileron. And we're seeing some kind of wonky numbers also here. Let's move this out here. As I mentioned, somewhere around the 445 to the 443, 441 area is what I would think would be a reasonable place to look for an intermediate term bounce that could resolve, maybe not to the all-time highs again, unless we get some really good earnings and fundamentals that come out. However, and the Fed backs off. Let's talk about that as an obvious point. But I want you to look at this as an area that could be for a shorter term move to the upside. So earnings season. I think this is really important also that we look at this is setting up really well. Today is options expiration. I've seen this before where things are either moved up or moved down into the expiration of options. And we saw this kind of a skew event to the downside. Options, obviously, for certain levels, what you had way out of the money options on the put side, or you sold some calls and you want to collect that premium that are expiring today underwater. It makes for a really interesting situation. I think right now, when we look at what is happening with regard to that, it could be a key setup. I mentioned this last week, that we could be setting ourselves up over the next couple of weeks into earnings season for tech. If tech earnings do come out and we see decent guidance, a lot of this can be resolved very quickly. Some of the names that we've been seeing down 30, 40, 50, 80%, well, maybe they deservedly are in those levels because they shouldn't have been where they were to begin with. However, are they opportunities? And I want you to think about that. I don't want you to look at the top, stock was at 100, now it's at 12, it can get back to 100. I want you to look at the overshoot to the upside, the overshoot to the downside. A good example, I think, let's look at this. is a stock like Matterport. And we talked about this, down about 4%, or was that 3% pre-market? And you look at this chart, we see this incredible overshoot to the upside, head and shoulders pattern, if you want to look at that. Now we're getting back down to where it was, all the way down below 10 to where it IPO'd. Does that make any sense for a company that really has a great opportunity and future into the metaverse and the kind of imaging that they do? Interesting. But this move, this fall, coincides with a significant amount of overshoot to the downside, just as we saw this overshoot to the upside. So where's your level? Where should we be? I mean, you could look at things like, well, how about in the 16 range? Is that an unreasonable level? Or for a company that has a good future, if it does, I'm not saying it does, I'm just saying theoretically, did it overshoot so much that maybe we could see this kick back to the 18, which is an 80% return from where we are right now? Something to consider. Maybe not this stock, but when you're looking at other stocks that are in this same look that we're seeing right now. Piton, we saw that, just an absolute disaster. Did it deserve to be in the 160s at one point? Are we seeing an overreaction, down 24% yesterday, now trading at about 25, a little bit of a bounce as they denied some hoo-ha news that came out yesterday about halting production. This is a problem. There's a lot of competition. We all knew that for a long time, but there's also some talk about layoffs, etc. Maybe a non-touch right now. So getting back to our topic at hand, and we'll get into a few more stocks. We're kind of blending it in a little bit today. Netflix, we talk about economics. We are seeing a little bit of slowdown recently, but it cuts both ways, right? The slowdown means that we would have a lower interest rate theoretically moved by the Fed, but they would say, maybe we shouldn't go as fast. And these ideas that we're looking for now, for somebody projecting 5 hikes in 2021 seems highly unlikely to me. The worst thing that can happen is that we have persistent inflation, a stock market that keeps on dropping, and the Fed that keeps on going after increasing rates. It doesn't seem logical to me. So last week was a short week. We saw housing starts, initial claim. Well, this week I should say, initial claims, existing home sales, Philly Fed. Next week's coming up, a few different numbers again. I think it's really important to consider that right now, if you're seeing a slowdown in those, realize it may see the concern bleed over to the market. The market's saying, oh, that's not good, right? It used to be that bad was good and good was good. Now bad is bad and good is bad for the very moment that we're in right now. Let's talk about a couple of stocks that you're asking me about here. Let's click over to, let's see what this is. Oh, my fingers aren't working so good today. Let's click this. KRI, a little bit oversold, -2 right now. This drip down isn't as bad. We're cutting right below this number. This was a pretty big whipsaw on the downside. I think the reason for that is that right now the big move on the downside was primarily in one area of the markets, and even though it's affecting a lot more right now, that was a problem. I think we'll get another tick down probably in the KRI today to a -3, one of the lowest we've seen in a while. Last time it was here, we did see this nice move to the upside, a jump to the upside. This is a little bit more of an ugly move to the downside, reminiscent of where we are here. Not getting a gap, just a consistent move to the downside right here. I think I've talked about this before, and I could probably show you this. Many of these gaps that we've had, these kinds of moves to the downside, have been going into earnings season. See that? These gap downs into into options expiration. Look, 720, 720, 719, 719. Here we are again in 720. What was this one here? 616, 617 into options expiration. They've been really moving these things down pretty hard. And I think there is something to be said there. And I would look for, I really would say that we'd lean on the other side of this right now. Somebody's asking me about CRM, which has obviously had a bad situation. 221 down to $1 right here, right now. Coming on support, 219 is where we are. Doesn't really break below. Looks terrible. How much more does it have to go? CRM has a great mousetrap. No question about that. You get in there, you really can't get out. I know this. And for everybody needs a CRM. So something to be said for that right there. Like I said, I think we're going to see a little bit of a turnaround here, at least a try to bust up. We just ramped pretty hot right into the open here. We'll see how that goes. Let's see what else we got here. Netflix, we talked about KWeb. I said keep a watch on that. Interesting, maybe breaking over I told you to watch for this breakout to the top here as something that I think is really interesting to watch. That's the Chinese or Asian stocks. Peloton moving up today on the fact that they said, oh, no, it's not true, the news. Okay. Let's see here. What else we got? Roblox. I find this very fascinating. It's a company that is being blended into all the mishigas that's going on with technology. I do see this move that was a little bit too much right here, but I think we resolved some of this. We are in a congestion zone that is incredible right now. Find it really interesting that they're backing it off so hard right now. We've talked about that. Right now, trading at the low point of support or at the support level. Bank of America, I mentioned the banks. Saw Goldman Sachs do really terrible last week. JP Morgan, the same. Everything's red. Everything's below. It's very difficult. What does that say? What does red say? What does it say when you're below the line? Well, it means do not be long if you are doing a day trade per se or a swing trade. Now, investing is different, and we have to acknowledge that. But if we are looking to be in a swing trade, a multi-day swing trade, this is do not be long. Wait till we get to the next level. So that's a problem. Where are we where we could be long? Let's see. Well, Ford dropped dramatically. It gapped up and dropped. Do not be long. Let's kind of repeat this. Below the line of red is do not be long. K-Web, breaking out. Could turn green here. Could be do not be short. Netflix, do not be long. Called it really well a few days ago. Beyond Meats, nowhere. AA, inside means no trade. IWM, do not be long if you're doing a swing trade. Same thing. I mean, we can go down this list. Here, let me give you one that's probably the other side here. XLE, look at that. Do not be short. We're green. We're above the line. We're holding very nicely. This looks like, once again, I will share with you, we're overdone to the upside. It looks like a parabolic move to the upside here. Everybody's all excited about crude oil. Here's this crude oil we're going to look at right now. Just going higher and higher. Down a little bit today, but not so much. Did bounce off support yesterday very nicely. And throughout the last night, moving higher, we are seeing a really good band on the upside of the aileron. So the momentum is in our favor. There's no question about that. And what's happening right now is that we are looking at the idea that we are over the levels. We're seeing really good quality information happen here. And that's moving nicely. Somebody's asking me about ITA, Aerospace and Defense. Big drop yesterday. I think this looks thinly, not thinly traded, but not fully traded. Look at this move up already. See, this is what I'm talking about. We really need to see that kind of hold off a little bit, dip, and then you may see a rotation in. It does look a little oversold on some metrics. As a matter of fact, when I look at the McClellan at a negative 217, not as low as it was back here at a negative 292 when you back up the truck concept, but here we're breaking down negative 79 on the Spearman as well. And this is all about the INX right now. Still some work to be done, it seems to me, to scare the crap out of people, but that's when you usually get those turns that seem to happen. ITA, on a long-term trade here, above 110, getting a little fussy down here. 102 is I think somewhere between 103 and 102 is probably some downside that I would expect to see on this here. So I don't know if there's any other stuff. Gold, a lot of people look at gold, kind of picking up. Green, do not be short, so possibly on the long side of gold. Looking good, up a little bit today. Silver looks about the same, I think. A little bit nice move in the last few days, picking up from 20 and a half, 21 we'll call it, to 22, about an 8-9% gain on that as this whole thing ripped up and people got very excited and upset and discouraged and distraught. So that's what's going on there. Listen, I want to thank you for joining me this week and each and every week. Make sure to be here. Tell your friends we'll be here next week with some more ideas, some more things. Check out TriggerCharts.com. We have replays of these in the morning as well as on our YouTube channel. I'll see you next week.